Our equity exposure is above average. However, the equity exposure, although it's above average, it is on average of a greater quality, higher quality, more global businesses, that we own in the portfolio today than we have in the past.
Where is this value-oriented, frequently contrarian manager investing now?
Funding provided by ClearBridge Investments, First Eagle Investments, Royce Investment Partners, Baird, Matthews Asia, Strategas Asset Management, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. We have a treat for you this week, a rare interview with great investor Stephen Romick, founder and portfolio manager of the FPA Crescent Fund, which is celebrating its 30th anniversary this year. Now, very few funds have the distinction of surviving, let alone thriving, for 3 decades. As a matter of fact, only 31% of U.S. domestic equity funds last even 20 years, and only a few dozen managers have led the same fund for 3 decades. FPA Crescent has another distinction. It's lived up to its founding mandate to deliver equity-like returns with less than market risk and avoid permanent losses. Its nearly 10% annualized returns have almost matched the S&P 500's, but its volatility was considerably lower. Both reasons that Morningstar gives it a gold analyst rating and named it Morningstar's Allocation Fund Manager of the Year in 2013. Those are among the reasons we are devoting 2 Wealth Track episodes to Romick. The first is about current strategy, and the second, to run in a few weeks, will be devoted to the lessons he has learned over the last 3 decades, or half his life, as he put it in a keynote speech from Morningstar, and we'll provide a link to this speech on our website, wealthtrack.com. FPA Crescent is a go-anywhere, invest-in-anything balanced fund that will hold large amounts of cash if it can't find attractive values in stocks, bonds, or other assets. I asked Romick how the fund is positioned now.
FPA Crescent today is got low 70s of the portfolios is invested. The balance is in cash. Cash is a byproduct of our process. It's a tool we use, that we default to. We don't consciously say we want to have X amount in cash. Right. If we have great opportunities, attractive risk rewards, we'll be much more invested. And so over time that cash will flex. But by having that cash and being willing to stand on the sidelines if we don't see the attractive risk rewards, it has protected capital in some of the worst downturns that we've seen over the last 3 decades. And a good manifestation of that shows up in this one statistic that I'm going to share with you. It's a little bit reductive to kind of put 30 years of investment history, as a manager into one statistic, but if you think about the maximum time to recover capital that was temporarily impaired, our maximum time to that high water mark has been 1.8 years, was the worst. So that means when the portfolio went down, to get back to the high water mark, the worst period we had was 1.8 years. And that's in part, through, stock selection, but a big reason for that is also, not, being fully invested, being in cash, because we didn't see the attractive risk reward. So we were right not to have been fully invested. I think that's what that shows.
Remarkably fast, compared to like the S&P 500, for instance, which took several more years.
Well, for over 4 more years, 6.1 years, to be exact, or the or even the balanced benchmark, the say 60% the S&P and 40%, the Bloomberg, ag, that was like 3.5 years.
So how do you explain that? Why is that? Why did you recover so quickly?
That's what I said. Speaking to the cash was in the portfolio, minimize the downside. And then coming out the other side, we leaned in, during the debacles that we've seen over time, we've been able to lean in. We leaned into COVID. More recently, we leaned in, last year. We leaned in, the financial crisis into distressed debt. And so we pulled down cash, and got more invested when opportunities were presented.
The fact that you're at nearly 30% cash now, 70% risk assets, what does that tell me about FPA Crescent's view of the opportunities in the market?
It tells you that we are not so sanguine as to be more invested. That we believe there's going to be more better opportunities coming our way, down the road.
And that you're not so pessimistic that you're not in, because is 70% about average for you all over 30 years?
So we're a little bit above average, but I mean, cash actually is an optimistic statement. One could argue we're optimistic that we're going to be able to deploy that cash in the future. To put an optimistic spin on it. But within that 70% and change, there is a little bit of difference. We've not seen the same kind of opportunity in high yield and distressed. And so we have more in equities than we've had in the past. So our high yield distressed component that within the risk assets is lower, far lower than its historic average, and our equity exposure is above average. However, the equity exposure, although it's above average, it is on average of a greater quality, higher quality, more global businesses, that we own in the portfolio today and than we have in the past.
Your aversion to, to losing money, you're avoiding the permanent impairment of capital. So is quality something that's going to is very important now? Is that what your assessment is?
I think quality is always important. It always has been. I think, as I said earlier on, I think I was a little bit slower to appreciate that.
Right. Because you've certainly done distressed debt, you've certainly done high yield in the past.
And we hope to do it in the future. Right now, the covenant quality, of these of so many of these higher yielding bonds is so poor. It's so covenant light that the balance of power is tilted towards the borrower, not the lender. When I make a loan to somebody and they don't perform, I want to get the keys to the kingdom, but I'm not. They make it a lot harder today, to get the keys.
Stephen, for the 7th edition of the investment classic Graham and Dodd Security Analysis, you were asked to write an introduction to a chapter about your evolution as a value investor. How have you evolved?
I think the largest theme within what I wrote in this chapter intro is really this idea of continuous learning, this idea of being a value investor, means to focus on a margin of safety, trying to protect capital. And you aren't protecting capital if you buy something at a low PE or in a low price to book for a business that is going to disappear. I mean, Sears looked like a value investment and did not end up, performing quite so well, as everybody knows. So the margin of safety earlier on in my career, having been schooled in the earlier, Graham and Doddian, mode of security analysis, which is protecting yourself with a balance sheet. So buying something below book value, or looking for hidden assets and being aware of hidden liabilities, that might be off balance sheet, contingent liabilities and such. And what I realized over time was that the value of the business was going to afford me great protection.
So can you think of a company that you've owned recently since that kind of revelation and that education as a value investor that you maybe would not have owned, 10 years ago?
Probably wouldn't have bought a Netflix a couple of decades ago. Google, we bought, over a decade ago. We've held it since, but we probably wouldn't have held it as long as we've held it. Probably would have been a more active seller, than we have been. Because we are more willing to accept that this is really a great business, and it's not without risk. We have to always examine the KPIs, the key performance indicators, as to what could impact its business, and we're very mindful of that. But we know we continue to hold that stock, whereas 20 years ago we would have bought it. Look, we bought Google in 2011 or so at roughly net of cash, give or take 11 times earnings. And as it migrated higher in valuation, we could have, 20 years ago, probably bought the same thing at 11 times earnings, the same business, but probably wouldn't have held it, or I may not have held it.
One of the things that you mentioned in your Morningstar speech as well is that you can get by with one thoughtful move every 5 years. So what has been your thoughtful move over the last 5 years?
In the last 5 years, we were not as exposed to a lot of these tech stocks that were very, very highly valued coming out of 21 into 22. We lagged, terribly going into that, versus a lot of growth funds, and looked pretty good, during it, and subsequently, coming out of it. And if you look at the fund today, we actually, through the end of the quarter, anyway, because I don't know the numbers as of mid-month on August, but we were actually, recovered to our high water mark, and the market hadn't. And people who had owned these inflated tech stocks are still significantly underwater, many of them, if not most of them. And so that's one thing that we managed to successfully avoid.
Except you just mentioned that you've owned Google for 11 years. So
but I framed it by saying inflated tech stocks. I don't think Google got to that point of inflation. You look at some of these businesses. I don't want to pick on any one business, but there's one company I have in the front of mind, because it's an industry of the same industry of the company we own. It's in the used auto retailing business that the stock it looked at it at $30, didn't buy it. $50, didn't buy it. $100, didn't buy it. Went to 350 or so, and they went all the way back down to single digits. And we looked at it up and took it in.
I'm trying to remember. Yeah.
Yeah, it's Carvana. It's a business that and selling cars out of gumball machines, which is. I'm not suggesting it's a bad business. Its economics are yet to be proven, and so those stocks became very, very inflated and reached. The stock declined 90% more, from its peak to its trough. So Alphabet was never inflated like that.
It wasn't. What about Meta, which you also own?
That was not inflated in that same way either. I just don't want to paint tech stocks with this brush that because it's a tech company, it's inflated in valuation.
Right, except they were kind of conflated as the mega cap, the FANGs. So there you are.
Sure, but a lot of these things, and a lot of these companies, and not focus on any particular one. Some of these companies we bought at points in time, when they'd fallen off,
right?
And, fallen out of favor. Meta, the Cambridge, was Facebook at the time, Cambridge Analytica scandal. There's different, these points, Netflix well off of its highs, and Google back in 2011. So we weren't buying these stocks at peaks.
You've got about 60 stocks in the portfolio today. So how does one of those companies make the cut? What's the process that you and your team go through?
We spend a lot of time just analyzing these businesses, and to make the cut, the better quality business that offers the better growth over the next 5 to 10 years, that is trading at the least expensive valuation. Attractive businesses at attractive prices.
Give me an example of a company that kind of epitomizes the process that FBA Crescent goes through that you hold now.
Every business requires a little bit of a different analysis. There's different performance variables that will drive these businesses. But one of the reasons why we were looking at Carvana was because we own a small position in CarMax. And CarMax is the largest used car retailer in the United States, and it's a business that's really got two parts. They sell used cars, and there's two components to that: retail and wholesale. And they also have a finance business where they will lend against the cars that they sell. They only have 5% or so of the market. Call it, there's 40-ish million used cars sold every year. There's 20 million or so used cars are kind of that fall in that, call that 0 to 10 year range, and in that 0 to 10 year range is really their sweet spot for retail, and they've got 5% or so market share. So we think there's a lot of runway for them to continue to grow, in that business. So we spend a lot of time talking to the company, talking to competitors, talking to, looking at the Carvanas of the world as an example, looking at competitors, and I started looking at this company back in. I think I first visited them in 2016. We didn't start buying them until a year and a half ago or so, buying the stock, and so it took some time.
Because of price.
Because the price was right, and we also had a better understanding of what the business could be in the future too. We thought their growth rate was somewhat finite because they were dependent upon these physical retail locations. And one of the things that changed, was that they was the ability to sell cars online. And so now you can buy a car from CarMax. You can start the transaction, you know, in the store and end it online, have it delivered to you, or you can start it online and end it in the store. I just sold a car to CarMax 2 weeks ago, and I was out of there inside of 50 minutes, having started the transaction online. And so I think, well, I don't think that the number of used cars are, you know, sold in the United States, it is going to necessarily increase and could even decrease. I do think that there's a lot of runway for this company to expand its market share. Now that said, you know, the stock's jumped up dramatically. It's up 50% from its low. It's not as attractive as it was, last year. But I think where they can be in looking out over the next 5 to 10 years could be very attractive. I mean, I think they could earn a lot more money than they're earning today.
You don't make a determination of you're going to have X percentage of cash, but again, but it's helped you in mitigating your downside risk and protecting the portfolio.
It's offered a smoother journey for those investors that care about the journey. I mean, look, owning an index fund can be a great thing to own, right? If you can, or an ETF where you got low fees and you get the market, you buy the market, you get the market's return, fantastic. But you have to ask yourself what your psychology is. Can you withstand as an investor, the bumps that are inevitably going to occur along the way? There's going to be some significant drawdowns. Does that drawdown precipitate an action? Does it cause you to sell at exactly the wrong time? So not everybody can handle that. Now it's important that as people look at the markets, as they look to invest, they're mindful of their own psychology.
So how would you describe the type of investors that should own FPA Crescent Fund? And what role does it have in a broad, diversified portfolio?
The way we use it for ourselves is we think of it as kind of a hub and spoke strategy. It's a core holding that, as you've commented on, has historically generated an equity rated return and avoided permanent impairments of capital. And if that's the goal of somebody as an investor, then it makes sense to put that in as this hub. And then on the spokes, you can go and do other things that more specific to an asset class or region, et cetera.
The protection that you get from your security selection, that the margin of safety that you build in, how much has that protected the portfolio as well on the downside?
It depends on a moment in time. The securities did not do very well in the great financial crisis, but we were so pulled back that our exposure was so low that it didn't impact the portfolio horribly because our net exposure was so low, and we had more shorts on at that point in time, in the portfolio. But other times, look, I think the important point I would share is that our equity selection on a gross basis has over many years outperformed the market on average, the MSCI ACWI, particularly since 2011 when it became a pertinent benchmark for the fund.
One of the things that also seems to be notable about your portfolio is its low turnover.
If you own quality businesses, your turnover, quality, sustainably growing businesses that don't reach a point of excessive valuation, then turnover should be low. It should be lower in the future than it was in the last, in the beginning, simply because if you're a value investor, the way I used to be, where I'm looking for an asset at a discount, if you buy an asset at 50 cents on the dollar, and that asset, increases in price and that discount narrows to 80 cents on the dollar, then you trade out of it and you have to go and find something different to buy. But if you own Google for, as long as it doesn't reach, as I said, this excessive valuation, like the Carvana example, which did reach that excessive valuation, then you can own it for a lot of years in a very tax efficient fashion.
You're known as a contrarian investor as well, and one of the lessons learned over the years has been don't run with the crowd, operate with a variant view, as you said. So how are you applying the variant view in the portfolio today?
The portfolio today, I don't think expresses such a terribly unusual view. I think a year and a half ago, we didn't own these tech stocks that were inflated in price. That really did show up then. And it does show up in smaller ways today, but not anything that's so significant. We bought some busted convertible bonds in the tech space, and we own those in the portfolio, where the credit investor, the debt investor had not really bought into, these unsecured convertible bonds of some of these tech companies, the idea of owning them, and we were
Right.
comfortable doing that. And so that's one example of having a more of a variant view, but I don't think there's a large overarching theme that you could point to in the portfolio today, other than cash.
We are in a new era of higher interest rates, higher inflation than we've been in the last, 10 years or so. So how has that impacted your portfolio and the opportunities that you see, or the lack of opportunities that you see? What difference has it made?
Well, I think that a lot of people say it will show me target values on a given company predicated on where that company or that sector has traded on average over the last decade. And my pushback on that is we are dealing with, we've just gone through not a generational low in interest rates, but the all-time historic low from the beginning of time, low level of interest rates. And there was no way that wasn't going to inflate multiples across the globe. I mean, when your cost of capital is zero or negative, the value of an asset in theory could be infinite, right? So I think that what we are mindful of is like making sure that we don't get anchored to just be something traded at a EBITDA multiple or a PE or whatever measure you want to look at some higher level in the past, that we're not just going to count on the fact that it'll get back to that level. And so that's where higher sustainable level of interest rates will have an impact. But where interest rates go is anybody's guess. We're not really that qualified to make that decision. But should rates remain high, inflation remain relatively robust, I think that people have to be prepared for not to get to some of the multiples that companies have traded at in the past.
And in 2014, you were very concerned about government debt and inflation, and you had some small investments in farmland. How concerned are you now about government debt now that it's in multiples from what it was?
I'm not any less concerned than I was, for sure, given that there's more debt today at the federal, state, and local levels. However, the difference between government debt and corporate debt, is that governments have a printing press. Federal governments have printing presses, and you also have you have taxation capabilities. You can kick the can down the road for a lot longer, and to try and make an investment determination because of that, and try and bring that thought of all those debt, say, okay, well, what's the impact going to be over the short term? It's beyond the scope of what we're really capable of being able to execute on. But we are mindful, that said, that with all of this debt, the cheapest way out of a highly leveraged situation at the federal level is to inflate your way out of it. And so that's why I don't think, with all the actions that are being taken, and that I think are probably likely to continue to be taken, that we won't see anything but more inflation, or some sustained level of inflation in the future. And so what does that do to interest rates? Becomes it's hard to keep rates, bring them as low as they were, if that ends up being true. But I think the logical path is really to inflate our way out of the debt problem.
So what do you do knowing that?
Stocks arguably are inflation hedges. I mean the value, with the multiple one puts on those stocks, will fluctuate based upon, on interest rates. Also, because you present value a stream of cash flows out into the future, and put a terminal value on it out at some point in the future. And if rates are lower, your value, your stub value today is going to be, be higher. But if you have a good business that's got, unit growth in front of it, pricing power available to it, then I think it's a pretty nice inflation hedge.
Stephen Romick, thanks so much for all your time, and thanks for joining us on Wealth Track.
All right, thanks.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is one of Stephen Romick's primary investment lessons from 30 years running FPA Crescent. It is don't run with the crowd. As difficult as it is to go against the investment herd, frequently the best investments are those that aren't working at the moment, that are unpopular. Romic lost 90% of his assets to redemptions during the end of the tech bubble by not investing in the dot-com craze, only to massively outperform the market for the next 3 years. He and his team bought into the COVID sell-off when many thought the world was ending and reaped the benefits afterwards. Going against the herd, buying when others are selling, selling when others are buying, and doing nothing in between is part of Romic and other great investors' consistent strategies. Well, next week, Muni veteran Robert DeMella assesses the health of the municipal bond market after last year's big sell-off. Opportunities and risks will be our focus. We invite you to follow us on Facebook, Twitter, and our YouTube channel, and we thank you for watching. Have a fantastic weekend and make the week ahead a healthy, profitable, and productive one.